Unit 6 Mutual Funds. Page 24.
Mutual funds. Mutual funds are associations or trust of members of public who wish to make investments in the financial instruments or assets of the business sector or corporate sector for the mutual fund benefits of its members. The fund collects the money of these members from their savings and invests them in a diversified portfolio of financial assets with a view to reduce the risk and to maximize their income and capital appreciation for distribution to its members on a pro rata basis. They enjoy collectively the benefit of expertise in the investment by specialists in the trust which single individual himself could not. Mutual funds is thus a concept of mutual help of subscribers for portfolio investment and management of these investments by experts in the field. A mutual fund has to get itself registered with the SEBI, as the SEBI regulates the securities market. The policies for regulation of mutual funds are formulated by SEBI. Management. MFs are set up as a trust supported by sponsors, the promoter, trustees, holding property of the MF on behalf of members of MF, and asset management companies, AMC, which approved by SEBI. Custodian that holds the securities. As per SEBI guidelines, at least 2/3 of the trustee community should be independent. Similarly, at least 50% of directors of AMC should be independent. Role of mutual fund. Mutual fund play an important role in mobilizing savings from individual for investing in the capital market. Hence, they are important financial intermediaries. As per SEBI guidelines, an entity or a person engaged in marketing or selling of mutual fund products has to pass the certification test from the Association of Mutual Funds in India and has also to obtain a registration number from them. Mutual fund terms. Asset management company. A company formed and registered under the Companies Act 1956 and approved as such by the SEBI to manage the funds of a mutual fund. Under an agreement with the trustees of the mutual fund, an AMC undertakes to formulate mutual fund schemes, distribute units, invest the funds in capital, money markets, and distribute income as per agreement. Discount or premium. The difference between the unit price and the net asset value expressed in percentage terms. If the price is higher than the NAV, the units stand at a premium, and if the price is lower than the NAV, the units are sold or purchased at a discount. Market capitalization. The total market value of a firm used as a measure of size. It is determined by multiplying the current price by the number of shares outstanding. Net asset value. The price or value of one share of a fund. It is calculated by summing the quoted values of all the securities held by the fund, adding in cash and any accrued income, and subtracting liabilities and dividing the result by the number of shares outstanding. Fund companies compute the NAV once a day based on closing market prices. Net assets value. The total value of funds, cash, and securities less than its liabilities or obligations. Mutual fund schemes. Balanced fund. This fund invests in bonds and blue chip stocks to conserve capital. It pays reasonable income, capital appreciation. Bank end loan. A fee charged by a mutual fund from unit holders at a time of redemption of units. Close-end scheme. A scheme where funds are raised for a fixed period. The scheme is wound up after that period and funds are returned with capital appreciation to their respective unit holders. Normally, a close-ended scheme is listed on a stock exchange. As per SEBI guidelines, such schemes could provide exit route either by way of repurchase by the mutual fund or by listing of units at a stock exchange. Equity income fund. A portfolio of whose focus is on stocks with highly dividend yields. Similar to growth and income, portfolios except that of these funds usually place more emphasis on dividend yield. Their objective is to provide monthly or yearly income to investors. Front-end load. A sales fee charged at the time of purchase.
Page 25. Growth and Income Fund. A fund holding large established companies' portfolio, offering the potential for both appreciation and dividend income. Growth Fund. A growth fund aims at rapid capital appreciation of funds by making investments in those securities which are expected to show large appreciation quickly. Gilt funds. Investment is made in government securities only where there is no default risk. NAV of such funds can fluctuate due to change in interest rates. Income fund. An income-oriented fund aims at giving regular income to its investors so long as the scheme is in operation. Index fund. A mutual fund which mirrors the performance of a particular index. Such a fund invests all or nearly all of its funds in stocks listed on a particular exchange and included in the index of that exchange, such as BSE Sensex or National Stock Exchange NIFTY. Liquid fund or money market funds. It is an income fund and aims to provide easy liquidity, preservation of capital, and provide moderate income. Investment is normally made in money market instruments such as treasury bills, certificate of deposit, commercial paper, government securities, etc. Offshore fund. A fund established outside the country. Open-ended scheme. A scheme is the one which continuously offers its units and buys them back from investors at net asset value (NAV) related price. The scheme does not have a fixed maturity period. Its key feature is liquidity. Tax saving schemes. A mutual fund scheme formulated under the Government of India guidelines on equity-linked saving schemes. Investors under this scheme are entitled for certain tax exemptions. Terminal questions. Question 1. A mutual fund is set up in the form of a company. Options are true or false. Answer is false. Question 2. A sponsor is like the promoter of a mutual fund. Options are true or false. Answer is true. Question 3. The trustees of a mutual fund hold the property of a mutual fund on behalf of the unit holders. Options are true or false. Answer is true. Question 4. Asset management company that manages the funds in a mutual fund is approved by dash. Options are SEBI or RBI. Correct answer is SEBI. Question 5. Performance of a mutual fund is denoted by dash. Options are market price of the unit or net price value. Correct answer is net price value. Question 6. Market price of the unit less expenses incurred on a mutual fund scheme is called dash. Options are NAV or realization price. Correct answer is NAV. Question 7. A scheme of a mutual fund that is available for subscription or repurchase on a continuous basis is called dash plan. Options are open-ended or close-ended plan. Correct answer is open-ended. Question 8. In a dash plan, the maturity period of the scheme is stipulated and the fund subscription is available for a limited period only. Options are open-ended or close-ended. Answer is close-ended. Question 9. As per SEBI guidelines, the close-ended mutual fund plan must provide an exit route either through repurchase or through listing on a stock exchange. Options are true or false. Answer is true. Question 10. The aim of a dash is to provide capital appreciation over a medium to long period. Options are income scheme or growth scheme. Correct answer is growth scheme. Question 11. The aim of a dash is to provide regular and steady income to the investors. Options are income scheme or growth scheme. Answer is income scheme. Question 12. The growth of money and regular income is provided by dash scheme. Options are liquid fund or balanced fund. Answer is balanced fund. Question 13. Dash scheme provides easy liquidity, preservation of capital, and moderate income. Options are liquid fund or balanced fund. Answer is liquid fund. Question 14. The investments of fund in gilt fund is in dash securities. Options are government or corporate. Correct answer is government. Question 15. A scheme of MF that invests primarily in other schemes of same or other mutual fund is called dash. Options are top fund or fund of funds. Correct answer is fund of funds. Question 16. The price at which a mutual fund repurchases the unit from an investor is called, options are redemption price or face value. Answer is redemption price. Question 17. The main function of asset management company is to manage the funds by making investments in various types of securities. Options are true or false. Correct answer is true. Question 18. As per guidelines of SEBI, a person engaged in marketing or selling of mutual fund products has to pass a certification test and obtain a registration from. Options are AMFI or SEBI. Correct answer is AMFI. Page 26. Role and functions of insurance companies and IRDA. First insurance company was started in India in Kolkata in the year 1818. The Narasimham Committee on Financial Reforms also suggested reforms in the insurance sector. Based on recommendations of R.N. Malhotra Committee, reforms were introduced in the insurance activity. Before these reforms, there were public sector companies only that were operating in the insurance market. These companies were LIC of India for life insurance and GIC of India and its 4 subsidiary companies for general insurance business. After reforms, the GIC has been converted into a national insurer, and the 4 subsidiary companies have been made independent companies. Legislation. Insurance business is regulated by Insurance Act 1938 and IRDA Act 1999. Reforms. In the year 1999, the process of opening up of insurance sector started. The steps included 1. Establishment of Insurance Regulatory and Development Authority IRDA in 2000 under IRDA Act 1999. 2. Raising the entry-level capital requirement for insurance business. 3. Permission to private insurance company to undertake insurance business. As a result, a number of new insurance companies in the private sector came into being. In addition, there is special insurance company for crop insurance, that is, Agriculture Insurance Company Limited. Type of insurance business. Insurance business is of 4 types. 1. Life insurance. 2. General insurance. 3. Marine insurance. And 4. Miscellaneous insurance. Insurance products. Life insurance, endowment assurance, money back, term insurance, unit-linked insurance products. General insurance, fire insurance, and miscellaneous insurance. Contract of insurance. It is a contract of utmost good faith, technically called uberema fides. Accordingly, the policyholder is expected to declare all material information. Any misrepresentation or non-disclosure leads to render the insurance contract void. Life insurance. It is a contract that pledges the payment of the insured amount to the person insured or his nominee on the occurrence of an event. The validity of the contract is up to date of maturity or specified date or death. Benefits of life insurance. 1. Encouragement to saving or thrift. 2. It provides liquidity in the form of loans that can be taken on the security of insurance policy. 3. It provides tax concessions. With-profit policies. In this case, the declared bonus is allotted to the policy and is payable along with the contracted amount. The premium is higher in this case compared with the without profit policies. Without profit policies. The contracted amount is paid without bonus. Key man insurance. It is taken by a business organization on the life of key employees to protect the organization from the financial loss that may arise due to sudden death of the key man in the organization. Group insurance. It is a plan that provides life cover to a number of persons under a single policy known as master policy. The cost of such a policy is low, and for policy purpose, the individuals are not assessed. Insurance agents. IRDA has prescribed minimum educational qualifications. For rural agents, it is 10th pass. For the insurance agents and corporate agents, they are required to undergo mandatory examination and training. Insurance ombudsman. Insurance industry has a number of insurance ombudsmen. They are empowered to redress customer grievances in case of insurance amount up to rupees 20 lakh. Bank assurance. Bank assurance stands for distribution of policies issued by the insurance companies through the bank branches. In other words, it is an arrangement between banks and insurance companies. Under Section 6(1) of Banking Regulation Act, Government of India allowed the banks in the year 2000 to undertake insurance business. Banks can undertake bank assurance by obtaining IRDA license without obtaining RBI permission. Bank assurance provides a business opportunity both to the insurance companies and banks. Banks can use their vast branch network and customer base to attract insurance business and earn fee in the form of commission. Since this is risk-free business for banks, there is no requirement for additional capital for this business. Page 27. Models of bank assurance business. There are 4 models of bank assurance that are used internationally. These include 1. Corporate agency or distribution alliance model. In this model, the banks distribute the policies of insurance companies. In India, this model is very popular. 2. Joint venture model, under which an insurance company and bank share the capital of joint venture. In certain cases, this model has also been used in India, where the banks and insurance companies have formed insurance ventures for insurance business. For example, ICICI Prudential. 3. Merger between a bank and the insurance company. 4. Build or buy own insurance operation, that is, insurance underwriting. Insurance Regulatory and Development Authority, IRDA. IRDA was established under IRDA Act 1999 on April 19, 2000, with the objective of promoting insurance market efficiency and ensure protection to the policyholders. The functions, duties, and powers of IRDA include issue of certificate of registration or renewal thereof to the insurance companies, protection of interest of policyholders, prescribing qualification and other requirement for insurance intermediaries, levying fees and other charges, calling for information, undertaking inspection, regulating the rates, regulating the investment policies, adjudication of disputes between insurance companies and intermediaries, Terminal questions. Question 1. Insurance sector is regulated by dash. Options are RBI or IRDA. Answer is IRDA. Question 2. Dash has been converted into a national insurer. Options are LIC of India or GIC of India. Answer is GIC of India. Question 3. Which insurance company deals with crop insurance? Options are AICL or GIC. Correct answer is AICL. Question 4. Dash insurance is compulsory. Options are life insurance or motor vehicle insurance. Answer is motor vehicle insurance. Question 5. Insurance products fall in two categories, which are dash and dash. Options are marine and fire insurance or general insurance and life insurance. Answer is general insurance and life insurance. Question 6. Dash fixes the rates for some of the general insurance products. Options are IRDA or TAC. Answer is TAC. Question 7. The term Unbrima Fides stands for dash. Options are insurable interest or utmost good faith. Answer is utmost good faith. Question 8. Insurance is a contract. Options are true or false. Answer is true. Question 9. Dash is a contract that pledges payment of an amount to the person assured or his nominee on the occurrence of an event. Options are general insurance or life insurance. Answer is life insurance. Question 10. The contract of insurance is valid for payment of the insured amount during date of maturity or unfortunate death if it occurs earlier. Options are true or false. Answer is true. Question 11. In a dash profit life insurance plan, the disclosed bonus is allotted to the policy and is payable along with the contract amount. Options are with profit or without profit. Answer is with profit. Question 12. In a dash profit life insurance plan, the disclosed bonus is not allotted to the policy and is payable along with the contract amount. Options are with profit or without profit. Answer is without profit. Question 13. Keyman insurance policy is taken by a business firm on the life of dash. Options are employees or key persons. Answer is key persons. Question 14. The plan of insurance which provides life cover to a number of persons under a single policy is called dash. Options are master policy or group insurance policy. Answer is group insurance policy. Question 15. Premium is higher in case of dash policy. Options are with profit or without profit. Answer is with profit. Question 16. Insurance agents have to undergo mandatory training as per prescription of dash. Options are RBI or IRDA. Answer is IRDA. Question 17. Dash conducts the qualifying examination for agents. Options are Insurance Regulatory and Development Authority or Insurance Institute of India. Answer is Insurance Institute of India. Question 18. Insurance Ombudsman or IRDA looks into policy holders' grievances. Answer is Insurance Ombudsman. Question 19. Sale of insurance policies of other companies by banks is part of dash insurance business. Options are bank assurance or underwriting. Answer is bank assurance. Question 20. Banks are allowed to undertake insurance business as per provision of Section 610 of Dash Act. Options are Banking Regulation Act or RBI Act. Answer is Banking Regulation Act. Question 21. To undertake bank assurance business, the banks need to obtain license from dash. Options are RBI or IRDA. Answer is IRDA. Question 22. The key objective of IRDA is to promote market efficiency and ensure customer protection. Options are true or false. Answer is true.